Well, you're with us on Moneycontrol, and I am Surabhi Upadhyay. It's Wednesday, we're in the middle of the week, and the good news is that the bulls have managed to prevail. They've managed to take small strides higher. We had a positive close on the market yesterday, and buy on dips seems to be the texture of the market. It seems to be the frame of mind of investors as well. Now, once again, we don't have too many major global cues to speak of. A lot of the Asian markets are still in the dark, shut for the Lunar New Year holiday. And we had a flat close on Wall Street as well. But here, there's plenty of action. There is the French president's visit that is underway. And of course, the AI Impact Summit in New Delhi, which is also getting us plenty of headlines. So let's actually do that. Look at the headlines of the morning, and then we'll take it up with our guests. Stocks on Wall Street closed Tuesday's session with slight gains, but the fall in software stocks keeps gains in check. The Dow and the Nasdaq both at 30 points. Meanwhile, major markets across Asia remain shut. The GIFT Nifty is indicating a positive open on B Street. US and Iranian officials hold second round of talks in Geneva. Iran's foreign minister says both countries have reached an understanding on main guiding principles to resolve their nuclear dispute, but that does not mean a deal is imminent. US Vice President J.D. Vance also added that talks went well, with both countries agreeing to meet later. Oil prices declined nearly 2% overnight as US and Iran signaled progress in nuclear talks. Gold and silver prices, however, declined amidst ongoing talks between the two countries and continued geopolitical unrest. Gold slipped below the 4,900 mark. US Trade Representative Jamieson Greer signals that the Trump administration is open to changing how its broad tariffs on steel and aluminum are enforced, as businesses argued that calculating duties has been complex and costly. If indeed there is any rollback, it could have a mixed reaction for Indian steel and aluminum players. Prime Minister Modi hosts French President Macron in Mumbai. Bilateral talks covered cooperation in industry, defense, clean energy, space, and emerging technologies. The two nations will also strengthen networks between startups and MSMEs, promote exchanges among students and researchers, and establish new joint innovation centers. Okay, so let's tell you a little more about global markets and the overnight action from Wall Street. Well, the action was absolutely flat. It was actually a very range-bound and a very choppy session, even on Wall Street. Finally, the indices managed to flash a little bit of green by the end of it. S&P 500, the Dow, the Nasdaq, all of those indices were up 0.1% by the end of it. However, software stocks in the US are still under pressure. There are still those continued worries about what AI means, whether it's going to really disrupt these businesses. So the usual suspects, you have ServiceNow, Salesforce, Oracle. A lot of these stocks were down between 2 and 4%. Amazon was up 1.2%, and that was quite interesting because Amazon has been on a continuous losing spree. The stock was down 9 consecutive sessions after the company announced its massive $200 billion spend on AI, which got investors really worried. But finally, that losing spree came to an end yesterday, and we had a minor gain, about 1% up on the Amazon stock. Now, not much action actually in the bond markets yesterday. US yields are very range-bound. The 10-year yield is around the 4.05% mark. Tonight, it's going to be all about the minutes of the last Federal Reserve meeting. And of course, then it's going to be more about inflation. We had the CPE data, come out, CPI data come out last week. And the PCE index numbers will come out on Friday. So more focus on inflation. The dollar, by the way, was up. Because even though those talks with Iran have gone on really well, I mean, the US and Iran talks, there's no clear deal just yet. And then there were some reports about the Strait of Hormuz being closed as well. The dollar index, because of all of this, rallied above 97. And like I said, while the Iranian foreign minister said that the talks are positive, I mean, the market was also watching this war exercise going on, in the Strait of Hormuz, because of which Iran shut down that strait. It's a very important point for transit of crude oil shipments, in the Middle East, in the Gulf. And, this is something the market was watching very, very carefully. It's a temporary shutdown. That's what Iran is saying right now. But again, it led to some concerns. The dollar was higher. Oil prices largely range bound. on hopes that eventually these stocks will result in a deal. And we had a bit of a decline. So the Brent oil, which is RQ, is still around $67 a barrel. This morning, by the way, from Japan, there's very good news. Exports for Japan have surged. Just imagine this. January exports for Japan up almost 17%. That's a 3-year high. And while shipments to the US have declined, Japan's exports to China are looking solid. And also to the EU. In fact, exports to other Asian countries and to the EU are up between 25 and 26%. And that's what resulted in the 17% rise in exports in January. Japan is the only market that's really trading across the Asian region, and it was up about 1% last I checked. Most of the other markets, including Hong Kong, mainland China, Taiwan, Malaysia, Singapore, all of them still shut for the Lunar New Year break. Now let's talk about our market action. So like I said, the good part is that this is a recovery on, this is a buy on dips market, and that recovery was quite heartening to note because the bulls managed to prevail by the end of trade on Tuesday. The buying was led largely by IT stocks, but then other sectors participated along as well. So, that was the other good part. The Midcap index recovered. We're a positive close there as well. FIIs, by the way, were buyers yesterday in the market. They bought equities worth almost 1,000 crore rupees, and that was quite nice to note. Domestic institutions were also on the plus side. They bought cash stocks worth about 187 crore rupees. So no complaints there in terms of flows, and FIIs also turning buyers for a change. The issue is what happens now, because the Nifty now is heading to its next challenge. And that is this resistance or this congestion zone between 25,800 to 26,000. Every time it's gone to 26,000, Nifty has faltered, it's failed. So will it be different this time around? Will that momentum finally really build up? That's the question that we will put to our guests as we go forward. And let me do that right away. Jatin Gedia is joining in. He looks at technical research at Teji Mandi. Jatin, good midweek Wednesday to you. Good to have you on the show. So what's the sense? Are you an optimist looking at the price action so far this week?
Yeah, good morning, everyone. So, the Nifty broadly has been stuck in this 500 point of range, 25, 500, 25, 450 has been tested a couple of times during the month of February, and every time the dip towards that support zone has been bought into. Now, on the upside, considering that we are in the final week of the February expiry, I believe that 26,000 is likely to again act as a resistance going ahead. The trade from here on would be to buy on intraday dips towards 25,650 on the downside, and look out for booking profit opportunities around that 25,900, 25,950 mark. So as we navigate this volatile session, we believe that there will be opportunities like yesterday, where we had this early morning dip towards the support zone, and thereafter we rallied towards the closing part of the session. So similar could be the case. We might see some muted start, and thereafter the up move is likely to resume towards that 25,900 mark. So ideally, buy the dips with a stop loss placed at 25,600, and on the upside we are expecting 25,900.
So, but you're saying that you will buy only when there is a dip back towards 25,650. You're saying at levels above 25,700 is probably not the best buy. So wait for a dip today.
Yeah, see, considering the overall volatility that we are seeing intraday, it's better to wait for a dip towards the support zone and then buy, rather than chasing the positive opening that we might have in today's trading session. So ideally, wait for an intraday dip, and thereafter enter the longs.
Okay. And is the Nifty a better trade? I mean, index level, Jatin, is Nifty better, or is Bank Nifty looking better?
Definitely, I would go with the Bank Nifty, considering that it is trading at close to all-time highs, and we believe that the banking stocks, especially the PSU banks, are showing a lot of strength. So one observation that we had day before yesterday is that 16.8% open interest was built in the day before yesterday's trading session. So that was the highest open interest build-up that we saw during the month of February. So even on the day when the trade deal was announced, the open interest was around 15.8 around. But day before yesterday, that was the highest open interest. So a lot of longs have been built up in the Bank Nifty, and we believe that Bank Nifty could be the lead or taking the lead or the front runner in this up move. So we are definitely positive on the Bank Nifty, and we are expecting levels of around 61,800 to 62,000 in the case of Bank Nifty. Now the crucial support is placed at 60,800. So I would be a buyer even at current levels in the case of Bank Nifty, and within among the two, Bank Nifty definitely stands out.
Okay, so Bank Nifty is a better bet. Got that, Jatin. By the way, viewers, we're live on YouTube, and this is that time of the next 15 odd minutes. If you have any queries on individual stocks, the market, indices, trades, or investment, you can send your queries to us live on that YouTube chat, and we'll see if our guests track those sectors or those stocks. Then we'll put those queries up, and we'll try and get you some answers. Well, let me welcome in Gaurang Shah into the conversation as well. Gaurang, good morning. Great to have you with us. How are you feeling this Wednesday?
Well, feeling good, but Mumbai traffic, Surabhi, has been terrible. I take the Dharavi route, and after the Sion Bridge, apologies, I got in late. Sincere apologies for that. Feeling good. I hope the market also makes all of us feel better. And our sense is that we should be heading towards 26,000 and beyond in the next couple of weeks and days. So I think optimism is there. It's only that patience will pay off over a longer period of time.
Gaurang, did you buy IT stocks since we last spoke? Because I think they corrected by some 10-15% since our last conversation in the whole mayhem.
Yeah, so Surabhi, we were optimistic then, we remain optimistic now. It was a knee-jerk reaction, Surabhi. We spoke about it, right? Last week, Wednesday, when we were in conversation. Even before that, we advised a hold and a buy. Earlier, we advised the hold and a buy. Even last week before that, even in that week where the Anthropic AI tool was launched in US and it created a mayhem in the frontline IT company names in the US, which leads to a domino effect into Indian IT companies. Surabhi, what I understand is that people overreacted, right? And one more important thing, Surabhi, I noticed was that in the last 1 to 3 weeks since the time this tool was introduced, none of the IT companies' management came onto any media and gave a cautious stance. In fact, I was listening into Tech Mahindra. I believe they were in conversation with CNBC TV 18, and they said that there is no such huge scare on the street that the businesses will shut down. We will have to tell people to go. Our revenues will take a hit to no extent, and it will be beyond repairable, etc., etc. So, let us understand one thing, Surabhi. This is an ever-evolving kind of a sector. Innovation, changes, modernization, automation is at the front of the IT sector. We have to accept that, but it's not like you have to write off the IT sector because of some tool being launched in US called Anthropic. Many more such tools will be there, but I think the Indian IT companies are quite strong and capable of withstand all such negativities or overhang or headwinds.
Okay, all right. IT has been an ongoing conversation, and it will continue to be one. Absolutely, I take your point. I heard those statements from Tech Mahindra as well, and Infosys themselves. Yesterday sounding anything but defensive. They're trying to now identify or quantify the opportunity, at least the target market. And Mr. Nilekani was so clear in his address yesterday that this is not about, the risk is not in the opportunity. The risk is in execution. Can companies execute properly as enterprises adopt AI? And, in that adoption, probably some of the IT services companies would very much have a place and a role. So we'll keep talking about this. Let's do one thing, gentlemen. There are a couple of other stocks in news as well. So let me run through that list. So here are the stocks that you should keep on your radar today. Starting with steel and aluminum stocks. Now, the US Trade Representative, Jamieson Greer, has hinted that US tariffs on steel and aluminum could be changed. There's nothing definitive. He's just said that the US administration could look at narrowing the scope of duties or how they are being levied. And this is because a lot of businesses in the US have complained that calculating these duties is getting very, very cumbersome. Right now, there's 50% duty on all steel and aluminum imports coming into the US. So let's see if this really plays out. Now, Eternal, yesterday, by the way, Swiggy and Eternal both were down because of certain new charges that the Karnataka government is levying for the betterment of delivery partners, and that's why the stocks were under pressure. Today, there's news coming in specifically on Eternal. It has partnered with OpenAI to deepen its AI integration across Zomato, Blinkit, and District. So AI is literally everywhere, including in quick commerce, it seems. Dabur is going to be seeing a bit of a management change. The company has appointed Harjeet Bhalla as CEO of the India business. Mohit Malhotra has been reappointed as the global CEO. So Mohit Malhotra gets elevated and Harjeet Bhalla takes on the India operations. Then we have a couple of order wins that could power up stocks today. Dilip Buildcon is one of them. It's been declared L1 for a project that's worth about 702 crore rupees. This is a project given out by the Gujarat government. There's BHEL, which has received a letter of award from SAIL for the construction of a captive power plant at the SAIL plant in Burnpur. The size of this contract is pretty big. It could range between 1,200 to 1,500 crore rupees. Speaking of awards, GPT Infra has secured a pretty large order. Over 1,200 crores is the value of this order. This is from the Northern Railways for construction of the rail-cum-road bridge in Varanasi, and this is in conjunction with RBNL. So watch out for both of those stocks. There's Healthcare Global. The board has approved the equity share issuance worth 425 crore rupees, and this is going to be via a rights issue. So the company is looking to raise some capital. So those are the stocks in news today. Okay, gentlemen, let me quickly get your take on some of these companies. I want to start with Eternal and Swiggy. Jatin, if I could come to you first on the technicals, there was a lot of decline and a lot of the selling was on good volumes yesterday on both the stocks, Eternal and Swiggy. What is the technical structure first up? I mean, where are they in terms of supports? Is there a trade? Is this a buy on dip as well?
Yeah, see, I'll discuss about Eternal. So, Eternal has undergone a 30% correction recently, and thereafter, it has witnessed a rise from around 250 odd levels and rallied up to 310. So, now the stock is only in the process of retracing that rise of 250 to 300. I believe that the stock has bottomed out, and this fall or the retracement that we are seeing is likely to be bought into. So I would be a buyer into this decline. I would place a stop loss at around 272 on the stock Eternal, and on the upside I am expecting 310. So we have a bullish outlook on Eternal. So use this dip as a buying opportunity.
Okay, all right. So technically, it's a buy on dips, says Jatin. Gaurang, what do you think of these stocks? Yesterday was this whole Karnataka issue that I think was weighing on the market's mind. But otherwise, at the end of third quarter, looking at the kind of burn rates, especially in the quick commerce business, where do you place Swiggy and Zomato?
So, Surabhi, look, before this Karnataka gig workers news came in, we also had news of Flipkart showing interest to get into this quick commerce or food delivery platform. So this is also one sector which is going to see elevated level of competition as and when new entrants will come in. And by default, Surabhi, as we all know, new entrants would want to take their market share, attract subscribers or customers. And while doing that, they may offer huge discounts, zero delivery fee, zero platform fee, etc., etc. So there might be, disturbances in the immediate short to medium term as and when these new entrants will come in. But without forgetting the fact that Swiggy and Zomato or Eternal happens to be the established players in this sector. They are seasoned, they have experience, and they will survive all this competition is what we believe. When the IPO was there, we had given a subscribe for Swiggy and Zomato earlier, Eternal earlier known as Zomato. But currently, we have a fund. Surabhi, a small disclosure that whatever recommendations that I'll be giving you this morning are a part of our fundamental research team recommendations from a long-term point of view. Our company, Ajit or I, we do not have any kind of personal investments, no financial interest, no conflict of interest. But we give advice to our clients on similar lines. They might have their investment interest. So Eternal is something that we have a fundamental coverage. 350 approximately is the target if I'm not mistaken and if I remember it right. And one more thing, Surabhi, is that last year Eternal for the Blinkit platform opened record number of dark stores. This year 2026 also they have huge number of dark stores lined up to be opened, catering to not only metros, tier 1, tier 2 cities, but tier 3 and tier 4 cities, getting a larger market share, getting a broader customer base, and that will translate into fees going up, income going up, and both of them are doing well. Food delivery platform as well as Blinkit are contributing to Eternal's balance sheet. So we remain optimistic on Eternal from a long-term point of view with 350 approximate targets.
So, and Eternal, and you prefer Eternal over Swiggy? Or Swiggy, you said you don't have active coverage.
Yeah, that's right. We don't have current coverage. We had covered it during the IPO and we'd given a subscribe for the IPO. Currently, we have only coverage on the fundamental side on Eternal.
On Eternal. Got that. And Eternal you think is a buy and 350 is possible. So there you see, both our technical and our fundamental experts this morning are agreeing on Eternal being a good bet at this juncture. Gaurang, steel and aluminum, what did you make of this? It's not really an announcement, it's only a report. Jameson Greer was speaking to CNBC US, and I think there he was quizzed whether the president is going to do anything about the steel and aluminum tariffs. And he said that, okay, maybe, we'll see. But he also said that the tariffs are working very well for the US. So, I mean, it's anyone's guess how you want to read in between the lines. But will it have any implication for the likes of Hindalco
guessing
or
is right,
Tata
but that
Steel? I don't think we
guessing has to be
export too
right,
much steel anyway to the US.
Yeah. Surabhi,
It's not easy to guess what the US government officials are up to.
Exactly, and more importantly, the US president, right? So I think this was a knee-jerk reaction. I got a lot of calls yesterday because of this, sell-off or meltdown in the metal pack, as they call it. But look, like IT, this was also a knee-jerk reaction. I mean, and Surabhi, I don't understand. We tend to overreact every time, whether it is to do with in India or whether it is to do with anywhere in the world. Some news flow and we'll overreact to it. So I think we should hold on to our horses. Metals are going to be performing well, Surabhi. We have coverage on metals also. Before I give out the names, let me, for the benefit of your viewers, Surabhi, have 2 years plus, 2.5 year plus kind of time horizon, because the issues that are in the backdrop or which are likely to evolve may have impact on the metal pack, depending upon which way the news flow is, positive, negative. Tata Steel, JSW Steel, Hindalco, Vedanta, NMDC, Hindustan Zincs, Nalco, Jindal Steel, if I'm not mistaken. These are some of the names on which we have a positive coverage. There is also a possibility, Surabhi, that because of the input cost coming down, the profit margins are going to have a positive kind of an impact as we go into the fourth quarter and the next financial year. And the consumption of flat and long products as far as domestic market is concerned is quite high. Given the backdrop of capex and infrastructure that the government has lined up both at the center and state, and along with that, Surabhi, I think with these FTAs being signed, sooner or later, private capex which is not picked up is going to pick up steam. And with that scenario, with real estate sector doing well, with cap goods engineering sector doing well, and the FTAs being signed, opening up opportunities, I think metal sector is likely to perform well.
And just recap your order of preference there, Gaurang, in terms of the stocks.
So Tata Steel,
in metals.
Yeah. So Tata Steel, JSW Steel, Hindalco, Vedanta, Hindustan Zinc, Nalco, and NMDC.
Okay, pretty much now in playing the whole sector then across ferrous, non-ferrous, playing most of the large producers. Got that, Gaurang. Now let me ask Jatin technically, because Jatin, the thing is that this whole metals trade got very volatile earlier in 2026, and there's a lot of nervousness, and that's why we get very sharp corrections, because the Nifty Metals Index, by the way, viewers, rallied. I mean, last 1 year the Nifty Metals Index rallied over 40%. So on such a humongous rally, sharp, quick corrections are also something you can expect. So how to navigate this, Jatin? And within metals, what are the better trades now?
Yeah, so rightly pointed out that Nifty Metal has had a very sharp run up, and generally post this sharp run up, what we see is a phase of consolidation. So exactly that is what is going on in the Nifty Metal index that we see. There have been sharp declines. However, that sharp declines have been bought towards the 20-day moving average. So I believe that there is no real sign of a major breakdown in the case of Nifty metals. However, there could be a lot of volatility and consolidation. The broad range that we are seeing on the Nifty metal index is around 11,400 on the downside and 12,300 on the upside. So this is the 900 point kind of a range within which the Nifty metal index is likely to consolidate. Dips towards the support zone should be considered as a buying opportunity. Now, stock specifics, we like Vedanta. So Vedanta has been consolidating in a range, and we believe that uh, 640 is a very crucial support for Vedanta. And on the upside, there is a scope for the stock to rally towards 720 on the upside. So within this metal pack, we are positive on Vedanta from a stock specific perspective.
Okay, so Vedanta is the one that you will pick out. Got that. By the way, the pre-open rates have come in. So let's just see what's going on right now. It's very early. It's exactly 9 o'clock. So these are the first rates coming through. But the indication is that we should get a positive start. That's what the GIFT Nifty was also telling us. The hint was always that we start on the green side. That's what the pre-open, at least for now, is suggesting. And it's not bad, about a 80-90 point up move. Mahindra and Mahindra is off to a bit of a flyer of a start. 3% up on M&M. Infosys, TCS, HCL Tech, Wipro. So your IT rebound seems to be continuing. And remember, I mean, all the news, all the announcements out of the AI summit in New Delhi, they've all been very positive. None of the companies are sounding defensive. Most are saying that they are changing and upskilling their workforce to become AI ready and become major partners and enablers of the whole AI transition. And that seems to be sort of calming some of those fears around how disruptive AI can be for Indian IT. Infosys is up, for instance, 2%, TCS, HCL Tech. All these stocks are flashing a little bit of green for the time being. By the way, that M&M rate was a little bit of a funny rate. Mahindra and Mahindra is now settled, so not too much going on there. But one clear trend in the pre-open session is that IT is still seeing some buying. Financials are a little subdued so far in the pre-open. Those are some of your IT names on the screen. Financials like ICICI Bank, SBI Life, slightly quiet, at least as of now. Let's wait for this to settle. Still very, very early. We've got about a 30-35 point up move on the Nifty that is underway. Okay. Gaurang, defense, that's the other sector to speak about, right? We had obviously Cochin Shipyard in focus yesterday because of this naval order, 5,000 crore rupees of naval order. And then we know that the whole, coordination with the French is also underway. The orders for the Rafales have been placed. And again, more commentary on, coordination on aviation, aerospace and defense. We've seen that yesterday as well. In this pack, would you make any fresh entry, fresh purchases?
So, Surabhi, look, again, before I give out the names, it will be prudent if I give out the time horizon. And the reason why the time horizon is important, Surabhi, is because of the high technical precision engineering outcome of the product what defense manufacturer. It's not like the Ministry of Defense will give an order this morning to any defense company and tomorrow morning they will start manufacturing mass scale. No, it's not like that. It's a long gestation, very difficult, high precision, high technology, complex engineering products. This will take time. It's not like, an indigenous aircraft carrier order will be given by the Indian Navy this morning to Cochin Shipyard and they'll make it in maybe 48 hours and give it. No, it takes time. So have at least 3 to 5 year plus kind of time horizon and to meaningfully make a decent return from your investments into defense. Because all these order books will, start getting executed over a period of time. In terms of preference, Whether I would definitely. In fact, for the last maybe about 3 years plus, we've been positive on defense. And I think now the opportunities are only opening as far as the export market is concerned. So we like Cochin Shipyard, we like Matsgaon Docks, we like BEL. We are positive on a company called MTAR Technologies, or you can, MTAR Technologies. This company, Surabhi, is into space science, nuclear. They are venturing into oil and gas also, if I'm not mistaken. And in the last maybe about 3 to 6 months, MTAR Technologies have been an outperformer, along with, of course, BEL, Bharat Electronics Limited. Even despite of the disturbance in the budget and the sell-off, then the run-up to post the announcement of US-India trade deal sell-off, I think BEL and MTAR Technologies have withstood all the difficult times. So these are some 4-5 names that we are positive on. Some of the other names, this is not a recommendation, Surabhi, but strong fundamental names in the defense pack. Hindustan Aeronautics Limited, Garden Reach Shipbuilders, Bharat Dynamics. From the private players on which we have coverage, Bharat Forge and L&T. Then there are other private players like Astra Micro and Paras Defense, etc. But have 3 to 5 year time horizon. And I think the most important thing would be to, if you eventually, understand defense and you take a call to invest in defense, do an SIP, every month, allocate some capital to these names. And I think laugh your way back to the bank once you earn a decent profits on such investments.
Okay. All right. So that's defense. A bunch of names there coming in. Jatin, would you want to add on if one and also tell us whether these would be short trades that you'll take in some of the defense stocks, or whether some of the names merit a place in the portfolio, like buy and hold from a wealth perspective. Anything in defense, Jatin?
Yeah, so we believe that BEL is one stock which we like. So technically, after a 50 day consolidation, it has broken out of that range on the upside. Now it is in the process of retesting that breakout, but overall we believe that the structure is still well and truly positive, and BEL is one outperforming stock within that defense pack. So BEL is one stock that if I need to have it in my portfolio, then among the defense, BEL is the stock to watch out for. In terms of levels, from a positional perspective, 420, 430 is a very strong support that we are seeing on the stock, and on the upside, the level of 500 will act as a psychological barrier. So BL among the defense pack would be the preferred pick.
Okay, all right, got that. By the way, gentlemen, allow me a couple of minutes. We've got a couple of interesting brokerage calls this morning as well. So let's bring our viewers up to speed. There is a call on ITC, there's a call on Maruti, there's a call on LG Electronics that our team has picked out among the interesting ones today. UBS has come out with a buy call on ITC. So let's talk about this first. Their target price, however, has been lowered from 420 to 395. They're saying that pricing approach may keep volumes and EBIT impact to a minimum. Price hikes will be fully passed on in the premium cigarette category. They're going on to say that distributor checks indicate that this is going to be the rough range of imminent price hikes. 64mm cigarettes expected to be priced at 7 rupees a stick versus 5 rupees 90 paise earlier. And the 84mm cigarette is expected to be priced at 24 rupees versus 17 earlier. So these are their channel checks, UBS channel checks. So they've lowered they still have a buy, but they've lowered their target price a little bit. The other call is on Maruti Suzuki. This is from Nomura, which is coming through. And Nomura is calling Maruti a buy. They're saying that the stock is competitively priced, the company is competitively positioned, and it's looking at boosting its EV penetration. They're saying that competitive pricing, however, could be a bit of a hit on profitability. So need to watch for this. E-Vitara has been launched at a very attractive pricing. So that trade-off between competitive pricing and margins, that's what needs to be carefully monitored for Maruti Suzuki. And finally, there is a call on gold on LG Electronics from Goldman Sachs. They've initiated coverage on LG with a buy call. The target price is 1750. That's Goldman. And they say that the shifting income mix and rising penetration will be driving the uptick of premium products. And the company is well positioned to grow faster than the industry. So that's Goldman on LG. Let's do one thing. These are some of the newer calls today. Of course, we've been getting you lots of brokerage calls on IT, given IT is where the big debate is. Check out some of the IT calls. We'll be back with our final rates and final trades with our experts as well. Okay, so those are some of the views on the street on IT names. The pre-open session has fully settled, so let's quickly tell you what's been going on over here. The Nifty has settled with a gain of about 27 points. It's going to be a quiet start, slightly cautious, building on those gains, but no bazooka this morning. It's just steady. That's the best way to perhaps put it. Midcap index is also up about 0.1, 0.2% in the pre-open session. No major trends to really highlight. If I look at the gainers on the Nifty, there are a few IT stocks which are still out there. For instance, TCS. BEL is the one stock that we were just discussing with our experts. BEL is looking quite smart, up 0.7%. And Eternal, now that it has announced this tie-up with OpenAI, and of course yesterday there was a lot of selling. So it seems that some buyers will come in on Eternal. At least that's the pre-open indication. Stocks up about 0.5%. We'll keep flashing you more rates, more gainers and losers. But those are the trends. ONGC is the big stock on the lower side. Crude oil prices, remember, have cooled off a little bit in the last couple of days. And ONGC is down about 2.5% as we speak. Among our stocks in news, the whole list that I was reading out, some of the stocks where companies have won orders, those stocks are looking good. So Dilip Bilcon, for instance, should be on our radar. And then you have Dabur, where there's a management change happening. That's going to be on the radar as well. Dabur is positive about 1.5%, and Dilip Bilcon is up 5.5%. Make that 6% now in the pre-open. So that's a smart mover. Okay, let's go back to our experts for some final ideas. So Gaurang, it's that time of the show where we get your compounding idea. You know, this is not for today. It's not for 1 week also. These are portfolio ideas. So what do you have for us today?
Well, so the banking, entire BFSI segment, Surabhi, has been holding out quite well. And in terms of Q3 earnings, I think the public sector banks have delivered much better numbers than what the street estimated or what our estimates were. So I think the frontline boy in the PSU bank, it's the largest bank in India and has been at a lifetime high. Correct me if I'm wrong, State Bank of India, Surabhi. We've been maintaining a positive stance for a very long period of time, and I think post the Q3 numbers, very much tailwind positive. The statement made by, or the guidance given by the management of higher credit offtake. So I think start at current levels and add on dips. mind you, this is a fundamental idea, so you need to have a longish time horizon.
Fair enough. So State Bank of India, indeed, it's at a lifetime high. What a mover it's been, really phenomenal. By the way, we have a question on Ashok Leyland as well. Very quickly, I mean, only 1 minute to go before the pre-open. Ashok Leyland, a viewer is asking if it is worth to buy and invest with a 5-year investment horizon. Gaurang, quickly, 30 seconds.
Don't even think twice. Please go ahead. You got a 5-year time horizon. I think it's going to turn out to be a great opportunity in terms of long-term investment.
All right, got that. And Jatin, quickly hitting the opening bell. Final trading ideas for today.
Sun Pharma would be a buy from my end. On the upside, we are expecting 1775, 1680 should be kept as a stop loss.
Got it. Okay, all right, gentlemen, thank you both very, very much. It's been great having you on the show, and very, very helpful advice, very stock specific and very focused, will help our viewers make their trading and investment decisions. Thanks, and have a great day, both of you. Thank you for joining in. All right, well, with that, let's take a look at this opening now. And this opening is quiet. This opening is not really doing anything at this juncture, is it? Flashing green, flashing red. Nifty is not able to make up its mind. We've got a 12-point downward drift as we speak. So what do we have? We have ONGC slightly lower, 2% to 2.5% lower. Infosys is lower by about 2%. Coal India is down about 1.5%. HCL Tech is lower. There's Tech Mahindra, which is down about 1% as well. TCS, Wipro, Tech Mahindra, actually all the IT stocks. They have all started off on a bit of a quiet note this morning. So we're not getting that follow through, at least not immediately. So those are the losers. They're coming up on the screen. The Nifty is down 12 points. I mean, it's not like it's really sliding or anything. It's just very quiet. It's just not much movement at this juncture. The IT stocks are now cooling off, given their run up yesterday, given the recovery from the lows over the last 2 sessions or so. Let's see what's happening on the gaining side, because there are a lot of stocks in green territory as well. Let's not lose sight of that. So if you look at the Nifty winners, you'll have names like BEL there. There's Hindalco that's reacting quite favorably. Eternal, we were just discussing the stock. Both our experts like it quite a bit. Eternal is up about 0.5%. Tata Steel is up. So basically, metals are making a bit of a comeback. And you have names like Trent, ITC, Eternal from the consumer space that are holding up. The Bank Nifty is absolutely flat. It's not giving away anything. SBI is a bit of a support this morning. ICICI Bank has a little bit of green on it. So basically, it's a nothing kind of an opening. Even the Midcap index, by the way, there's no directional move at all. The Midcap index is completely flat, completely quiet. Nothing really moving. I'm going to check out some of the stocks in news now. Let's see what's happening over here. Dilip Buildcon is up 5%. There's NetWeb. NetWeb yesterday announced an alliance. A lot of these companies, which are part of the AI Summit, they're announcing global alliances. NetWeb was one of them, up about 2.5% as well. Swiggy is also up. So Eternal on the Nifty 50. And Swiggy is the other one that's managing a 2.5% kind of gain. And NetWeb, by the way, launched a Make in India AI supercomputing system. And this apparently is going to be powered by NVIDIA. And that's what's getting the market excited. Dilip Buildcon is that order win that's keeping this stock very, very active. NDL Ventures is another stock. NDL Ventures, because the Competition Commission of India has approved the merger of Hinduja Leyland Finance with the company. So this is a Hinduja Group business where there are changes going on. So 16-17% on this one. Let's check out BHEL. Remember, BHEL got a big order from SAIL. It was an order worth almost 1,500 crores for manufacturing a plant, a captive power plant for SAIL. So BHEL will come up for you on the screen as well. It's not doing too much right now. It's flat. It's about 0.5% up. That's what we have on the screen. So those are the newsmakers. Finally, let me end this market check with looking at just overall mid-cap gainers and losers. Let's flash those stocks as well. On the gaining side, you'll find names like Ola Electric, Godfrey Phillips, Dilip Buildcon we've discussed. CE Infosystems is up and about. BSE is making a bit of a comeback. These stocks were completely pummeled earlier in the week because of this RBI rule on financing, bank financing to capital market players. There's a bit of a comeback today. Some of the PSU banks are doing pretty all right. Ashiana Housing is up. So lots of names on the upside. Now, if I look at the losers list, let's check out some of the mid-cap losers as well. See which stocks are flashing red today. Persistent Systems, I can see Natco Pharma. Natco had a great day yesterday, so it's cooling off today. There's JSW Infra, Oil India. In general, upstream oil plays are a little weak because oil prices have cooled off overnight. Rate gain is slightly lower, shopper stop is lower. So these are some of the losers. And we'll keep flashing more stocks for you on the screen as we go. But right now, it's time to welcome in our next guest. Jigar Mistry, founder of Buoyant Capital, is with us. Jigar, good morning. What a pleasure to have you with us on the show. Welcome to Moneycontrol.
Yes, Surabhi. Pleasure, always pleasure to talk to you. And congratulations on the new avatar now.
Thank you so much, Jigar. Yes, we're trying to make sensible, simple programming for all the Moneycontrol users out there and helping them with their trading and investment decisions. So I'm so glad you're here partnering us on this journey. So Jigar, let's start by understanding, because you and I haven't spoken for a while now. It's been a while, and there's so much that's happened, from the budget to the trade deal, to this whole AI scare. Earnings season is also over, and it wasn't too bad if you look at the numbers. So looking at core fundamentals, looking at earnings first of all, where do you stand and how do you just rate the earnings profile of our market at this juncture?
Okay, so our belief, Surabhi, was that the trade deal was a lot more important from a currency standpoint than it will help the GDP per se. See, we used to export an equivalent of 2% of GDP to the US, half of which was impacted. So say about a 1% impact. Now imagine, half of it was taken out forever. You're potentially dealing with a 50 basis point impact, which is not nearly as fatal as sort of the market believed. And I think very few sections of the market truly believed it because, the index was up, like the Nifty was up 2000 odd points from the time the deal was sort of the tariffs was levied till the time it was taken off. But FX was a different story because the current account over the last 4 odd years went into a deep red. Services flattened, exports, merchandise imports increased, and current account was in a bad shape. FDI became close to net zero. Right, gross there was still a lot of flows, but there was a lot of gross outflows as well. So on a net inflow level, we had like 1 billion down from 40 odd about 4 years back, and FIIs on the equity side were net sellers. So, current account bad, capital account bad, we ended up with a negative BOP. And, that was like a vicious cycle. So the worst, the current account, the capital account and current account combined became the rupee depreciated to an extent that it depreciated against a depreciating dollar last year. And therefore, the more FIs sold, the rupee worsened, FIs sold more. And that was sort of a vicious cycle until the trade deal comes and settles that for good, hopefully. So I think from a currency standpoint, it does a lot more than it does from a GDP standpoint. Budget was largely non-news because I would say, the government at the central level has now said two or three things. One, at the headline, 4.4 and going down to 4.3, the fiscal deficit number means a lot to them. They'll rearrange a lot of things so that we can report that number for sure. That may mean, some realignments, etc. But they are very firm on sticking to that number. Capex was sort of pushed out again. So, we are at around 10.5 lakh crores for almost 3 years now, or thereabouts. And I think next year may be a little bit difficult to achieve as well. Lastly, I would say, and this is maybe our reading, that we may already have seen the last of the rate cuts in India, right? Because the borrowing calendar and after that they did do some amount of swaps. But our takeaway was that at max we'll see like one, if not zero, rate cuts in India, and that means a lot for the lending institutions, so to speak. So I think this was our key takeaway from budget. For most industries, it was a no-brainer, or rather a non-event, and things moved along fairly fine. Lastly, with regards to the earnings seasons that we see concluding, I would say it's a fairly decent mark. Remember, 3Q saw some amount of follow through of the pent up demand. So the GST cuts were announced on 15th August. They took shape on 22nd September. So for that month, 2Q saw a bit of a shortfall, and then part of that got pushed out to 3Q. And the headline numbers, I think small caps have done better than larger caps. but we need to account for the fact that some of that may be one-off. But net at headline numbers, we are still seeing a single-digit growth for the third quarter in a row, which is far cry from the 12 odd percent that we are seeing or used to seeing on average. I think there are emerging signs of how things are picking up. Deposit growth rising at a fairly decent click is one of the first good signs. Our interactions with a few companies is suggesting that volume growth may come back in the fourth quarter. I know people have been expecting it for a while, but our belief always was that when you transition an economy away from capex to consumption, it takes time. And our hope is that 4Q things might turn better. So I think everything that was pulling India back, I think is now at the margin reasonably okay. I won't say things are great, but I think they're still reasonably okay. And we can talk about positioning when we come to it, but this is sort of the broad thought that we are approaching markets with, Surabhi.
Okay, so Jigar, from an earnings standpoint, if I were to ask you that over the next 3-4 quarters, purely in terms of earnings, which sectors could show the best earnings recovery or the best earnings growth, then which are the 2 or 3 segments that you'll point out?
Okay, so just like a minute's detour, see if you total what state center has sort of transferred in terms of money given in the hands of people, our assessment is it's almost 7 lakh crores. That is almost 1.8% of GDP, if memory serves. That is massive number by any stretch of imagination in any economy. And when that takes full shape, you would expect some sort of consumption place to emerge. So it started with discretionary, automobiles, two-wheelers, aviation. Our belief is that it will spread along to staples. So as a basket and staples, cement. So as a basket, I think the consumption theme is something that appeals the most to us today. We also think the sectors which led the rally from COVID till September 24 are something where shareholdings in retail has also gone up quite a bit, and we think that will take a step back. But what will drive earnings growth, to answer your question, is consumption, in our opinion.
So is your portfolio positioned for that, Jigar? I mean, what weightage are you giving consumer stocks in your portfolio? Is it more discretionary, or is it, do you think even staples will come back? How are you playing it?
We think staples will come back, Surabhi. So over the past year or so, it's tilted reasonably well in favor away from capex, railway, defense into consumption themes, both discretionary and FMCG. We also think banking and lending institutions, given that 3 out of the 4 cycles, we track basically the loan growth cycle, the NIM cycle, the asset quality, and the valuation cycle. Of the 4, only valuation looks like broadly full, but NIM looks like we are at the bottom end of the compression cycle. Loan growth will likely come back, and asset quality continues to be benign. So in that framework, banking, NBFCs, those sectors also appeal a lot to us. We have a sizable weightage there. And over the past 3 quarters or so, our exposure to consumption, both discretionary and staples, has also increased.
Okay, all right. So consumption is one big basket that gets your thumbs up. Jigar, what about IT? Where do you stand in the great IT debate? There are a lot of people who've said that there's too much price destruction that we've seen, and it's probably a good time to even consider buying some of these Indian IT stocks. But do you agree?
Not really, Surabhi. So we went into this debate with very low, if not near zero exposure to the big bang IT stocks for sure. Now, the argument is that nobody, frankly, knows what happens to the sort of the traditional plays if AI actually grows to an extent that we read. Again, nobody really knows how strong AI makes the life difficult for a lot of these companies, which we always thought was more like legacy plays where the archaic systems of banking financial institutions are matched to the swanky new front end for a lot of these US banks, and that work might never go away. But it's not outside the realms of possibility that you might not need so many more people even to deliver the job that essentially you have been doing for years. If that were to become true, then you are essentially pricing in very low sort of constant currency growth in the explicit forecast periods. And you would also start questioning the terminal value, whether it needs to be 4 or 5%, or maybe 1 or 2%. And if sort of, low explicit period forecast growth and near zero terminal value is something which consensus comes down to, then you are essentially pricing sort of a dividend yield play, which will be like 6 to 8%, 12 to 15% P for most of these larger plays. And we are not there yet, right? So I won't completely agree that, these are priced to assume extinction. Their value destruction has been large, but it's not something where, stocks don't work just because they are cheap. You will need to have this debate settled on either sides, and they're not cheap enough for us to imply a probability that if it works, then there is a huge upside. So frankly, we haven't dabbled in when we had near zero exposure to a lot of these companies.
Okay, so IT remains a no-go for you. Back to the portfolio question, Jigar. Then consumption. I mean, you've made your case very, very clear that you're optimistic. IT you're staying away from. What are the next big holdings or the next big weights in the portfolio then?
Twofolds. One, the exposure to healthcare is very promising for us. We are not really all that keen on GLP-1, but the contract manufacturing in all shapes and form is something that makes us interested. So the second largest exposure in terms of sectoral weights is healthcare for us, excluding hospitals. That's where we have near zero play. And secondly, some of this work where there are these newer industries in terms of how the managed office space, a few of these players have been listed recently, and that's the space that we like. So these are the two large outside the ones that we discussed. Surabhi is where our exposure has been.
Okay. That's as far as the portfolio positioning is concerned. By the way, I'm just going to get back to the market for a bit. Let's not lose sight of what's happening on the screen. And what's happening is really that the large cap screen is very quiet this Wednesday morning. There's nothing happening. Nifty is totally flat. But there's some interest that's now beginning to build up in mid caps. So let me look at some of the mid cap movers and shakers. The mid cap index, by the way, is up about 0.3% now. So it's flashing some green. Nifty is flat, Bank Nifty is completely flat. So it's broader markets, which is where the action is. Look at Misho. Misho is up 4%. Suddenly we're seeing plenty of traction over there. Those are some of the other mid-cap gainers on your screen, the larger stocks. There is Techno Electric. I can see Ola Electric. I can see Cohance Life. Edelweiss Financials is having a good session. Vodafone Idea on your screen. Poonawalla Finance. So a couple of these stocks also up and about. HEG from the material space, the graphite electrode maker, is up about 3.7% as well. So interesting, names up there in the mid-cap market, which are finding traction. And some of the financials, non-bank financials that is, continue to do fairly well. I'm just checking in terms of top volumes as well. On the volumes charts, what is working. So GMDC, SAIL, HUDCO, IOB, NBCC, NMDC Steel, a lot of PSUs actually doing well today across sectors. Metals for sure, yes, but even some of the banking names like IOB are finding a fair amount of traction. Metals actually doing quite okay. SAIL, like I said, is up about 2% as well, and those are some of the other PSUs which are up and about. And even, by the way, on the large cap screen, it's clearly a metals morning. Tata Steel and Hindalco are the two biggest gainers on the Nifty as well. So one clear trend this Wednesday morning is that metal stocks are back in favor. Let me ask you, Jigar, about this. And we were just discussing this with a technical analyst a while back. Metals have been the story of 2025. People who got in at the right time made a lot of money. But now it's getting a little volatile. What is your thought on commodities, on this huge upsurge in silver, for instance? A lot of people played that through Hindustan Zinc. Would you be a buyer in the commodity trade and in metals specifically?
So there is a long-term argument should be that, these are play on a weakening dollar, right? And maybe we were one of the first subscribers to this thesis that eventually if it costs the US 8.6 cents to print a $100 bill, and they've printed 8 trillion of them since the GFC, central bankers around the world are not going to like this, and they may continue to, hold the sort of dollar positions that they had, but incrementally they might want to look for options. Now, when they do that, every country will de-dollarize in their own way. So if it's India, we'll do it through gold. If it's China, they'll do it through commodities. So every commodity with a limited supply, when denominated in a fiat currency like USD, will be inflationary, is the underlying message. That is for the industrial commodities, where at least you can have some sort of a semblance of demand and supply. For the precious metals, they act as also the purveyors of value. So it's not just a medium of transaction, which is very difficult, but they are also a store of value. And any asset that aims to be a serious store of value cannot be as volatile as the precious metals have been, right? That is why I think cryptocurrency never assumed a very large status, besides obviously not finding legal parlance in every country. But gold and silver, when it sort of starts moving 10, 20, 30% up and down, I think a lot of people will get very jittery about things. And historically, precious metals have had parabolic moves only to flatline for a very extended period. Again, speaking historically. So our belief is that if that is playing out, then it does show a lot of retail interest. And that's one time when you should take some money off the table. So in fact, we were reasonably heavy on metals and mining last year, but we have pared down positions significantly in that space.
Okay. All right. So you've taken some profits off. Jigar, finally, to kind of sum it up, what would your advice be to viewers? We are practically done with this financial year. There's one more month to go, one month, 10 days odd. So at this juncture, all things equal, consumption is a very clear call you've given out. Where else can money be made and what should one avoid? Again, you've singled out IT, you've singled out metals where you've turned a bit cautious. Just sum it up for us.
So one big thing, Surabhi, I would say is that, see, 81% of all demat accounts today have come in post-COVID, right? Most of these investors have seen one cycle where you've seen Nifty grow from, say, 15 to 32% CAGR. You've seen small caps grow from 25 to almost 52% CAGR. But when you average it out over a 10-year rolling return, both for large and small caps, the average earnings growth is 13, 14%. That's have been the market returns. Now, this data was always present, but for somebody who is used to a 30% return to now accept 13% as an ongoing thing, if that can happen without a lot of portfolio destruction, that would be sort of, more seamless. Most people will find 13 attractive only when the portfolio shows a negative 20, 25%. But if we can seamlessly move into that direction, where long-term your EPS and share price growth must always align, I think constructing portfolios to deliver that kind of return, rather than just sort of swinging for the fences, may be the bigger call for the day. As far as sectors are concerned, as I said, where earnings growth, where we see more than 13, 14 is consumption, lending institutions. BFSI, other than lending, also is interesting, and healthcare. And we are not all that gung-ho on metals and mining and IT.
Okay. All right. Got it. Jigar, good conversation as always. Thank you so much for giving us some fundamental viewpoints and context. Very helpful for our viewers. You have a great day and we look forward to connecting again soon. Thank you so much.
Thank you, Surabhi. Have a great day too.
Okay. Thank you. Thank you very much. By the way, let's fire up the Nifty IT index and see what the overall IT index is doing. It's actually not doing anything today. It's neither falling much nor it's declining. Actually, I stand corrected. It is falling much now. The IT index is down again about 1.25%. Yep, the IT stocks have started their decline again. They opened fine at around 915, 920, but now the pressure is showing up. So Infosys, Tech Mahindra, Wipro, all of these stocks are down more than 1% again. Yesterday was a relief rally. Monday there was some pullback from the brutal thrashing. But again, you're seeing that weakness come through. So really, what is going on? And, can Indian IT services companies, legacy companies like Infosys, like Tech Mahindra or Wipro or TCS, can they withstand the AI onslaught? Well, that was something that Infosys discussed at its Investor Day yesterday. So before I invite my next guest on the show to talk about IT services, let's actually listen in to what Mr. Nandan Nilekani explained to investors. He said that this AI wave is going to lead to a fundamental cleanup across Indian IT services, across business models. And he says that companies like Infosys will still remain relevant. And in fact, it will be these companies which will help address the AI deployment gap. Listen in.
Fundamentally, the tech will keep getting better and better because billions are going to be poured into it. There's massive competition, but enterprise deployment is not going to go up. And this deployment gap is what we can help to address. So again, it's a very important point. Now, I think talent transformation is huge. It's not that you will need talent, but it will go from QA testing or development. We have all kinds of new roles: AI engineers, forward deployment engineers, AI leads, forensic analysts, data analysts. So fundamentally, the challenge will be how do you take your workforce and make sure that they are reskilled and ready for the new business. And that's really the challenge that all the firms will face. And this is something, so there will be roles. Now, the way you hire will change, the way you train will change, the way you deploy will change. All that is going to happen. And I think we'll have sessions on that. But fundamentally, there will be a need for people, but they'll be doing different things. Also, a lot of the talk of productivity is greenfield. Writing greenfield is not a big deal. I can take a tool and give it to a kid and he'll generate 1 million lines of code. But that's not the real world. The real world is the fact that companies have trillions of dollars invested in their systems. They have technical debt. They have data silos. They don't have documents. Somebody was telling me the other day that there are some old systems, and on contract they have guys as old as me, 70, 75-year-old guys, because nobody else knows what the hell is going on. And then when there's a crisis to be sorted out, they're pulled in from Phoenix or Florida or wherever they are, and they have to solve problems, and nobody else knows how to solve. So we have that kind of situation out there, undocumented dependencies. So taking brownfield systems and modernizing them is a hell of a lot more difficult than doing greenfield development. And a lot of us get biased because all the guys who talk about productivity are talking about greenfield development. And therefore, getting these large enterprise organizations' productivity going. Also, AI implementation requires laser focus. The very fact that you can generate stuff means you can generate slop. In fact, 5 years from now, there'll be more AI legacy systems than any other legacy system. All kind of stuff will have been generated, and we'll have to clean that up also.
As always, Nandan was very inspiring, and if you heard that entire conversation, was about a 20-minute address. You probably ended up feeling that this is definitely not curtains for Indian IT services companies. And he highlighted that the risk is not the risk of the opportunity, whether AI will take away all the opportunity for Indian companies. No, that's not the risk. He said the risk is execution. Can companies pivot quickly enough to be in that new role, to be IT enablers and help enterprises adopt AI? So the risk is execution and not the opportunity. Very well explained. In fact, we'll play out the rest of that commentary after this conversation. Let me now welcome in Ajit Deshmukh, MD at Aquarius. Now, Ajit is someone who's watched IT companies, legacy companies, IT services companies, I think new age digital companies, all of them very, very closely throughout his investment banking career. Ajit, welcome to Moneycontrol. Thank you so much for joining in. Good morning to you.
Good morning. Morning, Surabhi.
So, Ajit, world over, investors are writing the death knell, the epitaph, the tombstone inscription for IT services, whether it's SaaS, whether it's cloud, everybody's saying it's over, khatam, you know. And the market is trying to make sense of it. One day these stocks get sold, 10-15%, then buyers will come in. It's a very confusing phase for investors. What would your opening statement be in this environment?
Thank you, Surabhi. I think it's a very difficult thing to say anything about AI and IT right now. I think lots of people have talked a lot, but short answer is AI is definitely not a death nail for the Indian IT services industry. That is for sure. Mr. Nilikani mentioned in his speech yesterday at the investor conference, it definitely is going to change the way Indian IT looks at things and the way things are done in terms of the business model, and it will definitely require some strong and definitive management decisions in Indian IT, but definitely not a death nail. And the reason I say this is because this is the first time in the world we are working with something that computer does for us, which is probabilistic rather than accurate accurate always. I mean, we have been used to simple Excel spreadsheets which do 7 into 4 is 28, and there's no confusion. What we get as output from AI is not necessarily accurate output. That essentially means that there'll be a lot of data annotation, there'll be a lot of training of the model, there's a lot of work to be done after the AI has done something to get the required outcome with required level of accuracy. And that's where Indian IT will have to morph. In that context, it may change the business model from a pyramid model to more like an Eiffel Tower model. And the companies which will be early in doing that will survive. I think it's a longish answer, but I hope you got the point that I'm trying to make.
Yeah, I did. Can you actually expand on that? Analogies are always very helpful, and especially in a very technical subject like IT. So you're saying the model is going to change from a pyramid-like model to an Eiffel Tower-like model. What do you mean by that?
Yeah, of course. So if you look at a traditional IT services company, really speaking, the model is you have one person who's the leader, then you have multiple layers of leadership, and then you have a large number of coding and those type of people. Okay, the way this will work, the whole structure looks like a pyramid in a typical IT services company still now. In Eiffel Tower, you will have these set of engineers who are doing lots of stuff, and then you will need a large number of people who will do the data annotation and correction of models and training of models and so on and so forth. Okay, the top layer, which is a thinner layer, will have engineering skill, will have skills to work in AI models, create models, work with partnerships with somebody like Anthropic and so on and so forth. And the bottom layer will have these kind of things. Also, this will move to a time-based model, which means that manpower into billing rate is my revenue, to more of a model as outcome and intellectual property. So the companies who have built expertise in particular sectors, who have partnered with their customers as intellectual property partners, will see a lot of benefit in this AI journey.
Speaking of partnerships, Ajit, what did you make of some of the announcements from the AI summit? I mean, we are already hearing, I think Infosys itself announced some sort of a partnership with Anthropic. I mean, there are partnerships with various entities, including OpenAI, that have been announced. And we don't have too many details right now, but what is that relationship that you see Indian IT companies, legacy companies, trying to forge with these larger global entities that are at the forefront of the AI chain?
Let's go back some years, and similar partnerships were forged with ServiceNow, Oracle, and SAP, and so on and so forth by Indian IT services companies. And the partnerships, if you look at the dollar spent by an enterprise on product versus the services required to get the product productive in their shop, is about 1:5, which means if they give $1 of revenue to somebody like ServiceNow, they will give a $4 to $5 revenue to partners of ServiceNow to get ServiceNow implemented in their shop and get it productive in the shop. Okay, and that's what will happen with the new AI. So instead of doing a partnership with ServiceNow earlier, now I'm doing it with Anthropic or what have you. The type of work keeps on changing. but the
Okay.
need for that work doesn't
Yeah.
go away.
Okay. Now, but all of it, now I'm going back to something that made a lot of sense to me actually, as an observer, as someone who was listening into that call, the Infosys call yesterday, what Mr. Nilekani said. So there is opportunity, and that's what you're saying as well, that there will be opportunity. Indian companies will still have a role. They'll have to find different partners, bring a different set of services, AI-enabled services and AI-first services to their customers. So there is opportunity. The question is, are Indian companies ready to seize that opportunity? Now, how do you rate and rank the efforts that a lot of Indian companies have been making? We've been hearing about them upskilling. We've been hearing them about trying these, new agentic AI models, these new AI agents. How do you sort of rate these efforts, and are they good enough?
Difficult question. All I can say is we are definitely. If you really look at the Kodak movement, when Kodak, whatever happened to Kodak in terms of photography didn't go away. People with digital lenses and digital situation actually made money. And your question is very appropriate. How many of the IT companies are doing this? The good news is that all of the IT companies have very strong balance sheets and have very strong management layer. I have full confidence in Indian IT's management to really see the change and implement the change, and they have the now. I think the only thing that I would say, and this is something that is a difficult statement, and is that the market has to be patient and market has to give that support to the Indian IT companies rather than saying that everything is over.
So I know, Ajit, that you're not in the business of calling out stocks and stock prices. That's your securities team, and I'll talk to them separately. But so what was happening, but still just from a directional standpoint, what was happening in the last couple of years was that these legacy large IT services companies, they were left untouched by investors because they simply didn't have growth. They were barely growing, 0%, 2% kind of growth. But you had a bunch of mid-cap companies which were offering better growth prospects. Now, some of them were these ER&D companies, or some were, into a different kind of products and platforms, etc. So basically, mid-cap IT became a sweeter spot than large-cap IT. Now, as this AI transition, sweeps across, will investors be better off going back to the legacy large IT players because they have the muscle, the might, the investment power to really upskill quickly? My simple question is that over the next 1 to 2 years, will the large cap players become, emerge stronger in the IT, in the AI world versus the mid cap players?
So I would go back to not differentiating large cap versus mid cap in this context. I think a elephant takes longer to turn and change direction than a small animal like a leopard or so on. Right? I think that's the difference between, so that it's more nimble, more agile, and so on. Having said that, some of the large ITs, of course, like you rightly pointed out, have strong balance sheet. Not only that, they have very strong management who understands that they need to change, and they need to change fast enough so that the market doesn't sort of vapor away from under their feet. Okay? So my guess is that it will remain to the change in the thought process of management, and people should spend more time in terms of understanding what the management thinking is. Are they living in the past and driving the car with rear view mirror, or are they looking forward?
By the way, I just want to point out here for the benefit of our viewers that go on, Ajit.
Yeah, and we saw similar thing happen when Y2K happened. It's slightly different, but there were lots of companies who had just grown during Y2K because there was a huge arbitrage and labor arbitrage at that time. And companies who use that to create a platform and then move to newer and newer technologies, look at where they are and look at some of the companies which didn't move that well.
Got it. By the way, I just want to point out to viewers that Equirus Securities actually has a fair amount of bullish calls on IT. Like I'm saying, Ajit is not the person, he is the M&A expert, but we will get the securities person. Please tell your colleague from the securities team, Ajit, to also join us. We really want to get the specific stock call rationale as well. But I'm just laying it out there from their latest report. This is one of the recent reports after the earnings announcement. So Aquarius is a long call on Infosys, KPIT Tech, Cyient, Birlasoft, Mphasis, Tech Mahindra, Sensar. So you can see a bunch of stocks, including mid-cap names over there. They have ad calls on TCS, Coforge, eClerx, HCL Tech, LTI Mindtree and NetWeb. Again, it's a mix of large cap and mid cap, and that's the point that Ajit is making, that the opportunities are going to be across the market cap spectrum. The reduced calls are only on 3 stocks actually: L&T Technology Services, Persistent Systems and Wipro. That's just for our viewers' reference. So Ajit, the final point then, actually we haven't discussed valuations. Before I ask you the final question, the valuation question. So IT has also corrected. It's corrected big time, the listed IT stocks. So when you hear conversations, and since you're very privy to those conversations on the M&A side as well, what investors are saying, what private equity is saying, how are Indian IT companies' valuations looking now?
So I'll come in from an M&A perspective. This is a great time to start using your balance sheet and doing acquisitions. Lots of good companies are available at a reasonable price for these companies to buy. And this is the time where they can actually get the outcome-related companies in India as well as abroad at a decent valuation.
Okay, let's see if this triggers a wave of M&A.
I'll let my securities team talk about market valuations, but I'll talk about the M&A valuations.
The M&A valuation. You're saying from that lens, the landscape is looking interesting. And let's see if AI really triggers a wave of consolidation. If it starts more M&A in the sector, we'll wait and find out. Ajit, so final question. I mean, what would you tell viewers watching today? And again, I know that you're not the equity expert here, but again, just bucket the current listed IT ecosystem in different buckets, maybe legacy players, like I said, ER&D, and all these different differentiations are there. And what should investors track carefully? What are the triggers or the milestones that they should keep looking out for in order to come to the right investment decisions? What to track?
Yeah, let me give you a completely different perspective, and it may be useful for investors. Till now, the insurance that most of the IT companies buy is only errors and omission business insurance, and insurance if somebody gets hurt on the job. Try and see whether they are participating in the insurance of the client, which means they are really becoming intellectual property partners with their client. So if there's a car recall, will it hit the IT company also, because their thing is impacting the intellectual property that is going in the car? If something like that is happening, these are the companies to buy in the long term.
Okay, all right. We'll keep that in mind. Great conversation, Ajit. Thank you so much for joining in. Sometimes it's helpful to not look at a very narrow buy-sell lens, look at a slightly bigger picture and see how some of these waves of technology change, how they've played out in the past, and whether this time it's going to be different or a little more of the same. We'll find out soon enough. But thank you so much, and we hope to remain in touch and keep having these conversations. Thank you. Thank you. Have a good day. All right. Okay, viewers, before I wrap up with, again, going back to Mr. Nilekani's conversations on AI, I just want to point out that the market is under a little bit of pressure, not too much, 0.25% down on the large cap index. Mid cap index is completely flat, and you can blame IT all over again, because again, the sell-off in IT has resumed. IT is indeed the culprit. The Nifty IT index is down well over 1%. Let's pull up the stocks if we can. Infosys, Tech Mahindra, Wipro, HCL Tech, TCS. The slide has started. So the conviction is missing. And there's a lot of short-term tactical trade that's going on in these stocks as well. Remember that. So those who got in when the crash happened probably are looking to take profits as well. And therefore, you're seeing pressure on these counters. So, being nimble is perhaps the need of the hour. If you're trading in and out of IT, that's the short point. That's the IT index down almost 2.5% now. And it's the biggest culprit for the Nifty right now. Nifty itself is down about 50 points. So as we wind up this edition of Opening Bell, let's actually take it right back to the man who's seen as many people as one of the original faces of Indian IT services and the Indian IT movement, Mr. Nandan Nilekani, who was speaking at the Infosys event yesterday. And he was explaining to investors that there's definitely an opportunity and definitely a role for Indian IT companies. And he said that who else will do it? It's going to be companies like Infosys that will help with the AI adoption when it comes to large enterprises. Take a look at this, and thank you so much for watching.
Tech transitions, I have had the fortune or misfortune of being in this industry for more than 40 years, and I've seen a lot of transitions. So I thought I'll talk about less about that and more about why this time it's different and what are the implications of this transition. Now, safe harbor clause. Now, we have seen technology shifts, for centuries, whether the printing press or telegraph, but over the last, 60, 70 years, we have seen a much faster change, and PCs, cloud, Gen AI, agentic AI, and so on. So change of technology and the speed of change has been a constant for many decades now. And each time there's a change, the way we address that change has been different. So we went from mainframes to mini computers to PCs, client server, LAN, web computing, mobile, enterprise apps, big data. And each time we had to think of it in different ways. How do you think of it in terms of making it globally available through internet, or how do you do enterprise IT? So each time there was a tech transition, it had certain implications for us. And firms like Infosys had to deal with what was new. So we are used to the fact that each time there's something different. This time, the AI transition has been much faster than earlier transitions. If you look at the number of years it took to reach 1 billion users, internet took more than 10 years, smartphones took 5 years, AI is taking a couple of years. Now, you have to realize that the AI speed is because of the first two things. Because internet was already ubiquitous, smartphones were already ubiquitous. It therefore allowed people to distribute a ChatGPT or Gemini or Claude very easily. So in some sense, the speed of AI is also because of the infrastructure of the previous era. Now, what has happened this time is that this is a much more fundamental change to the way businesses will operate. So this is not a layer of technology. When we had, when smartphones came, we could build applications where instead of having a PC, you did it on the phone. It was like putting a front end to an existing application. When cloud came, we could do a lift and shift. You could take the app from your in-prem and move it to the cloud. So you could do a lot of things to get going. But this time, it's not that. This is a fundamental change in the way we do things. Obviously, there's a technology dimension, and it's all about having AI native architecture. But there's a whole business dimension to this. We cannot run business the old way. And businesses have to change, the customer journeys have to change, all those things have to change. It's a huge challenge for talent. Talent will have to deal with a world where writing code will not be the goal. It will be actually making AI work, orchestration, and those kind of things. So the jobs will change. And operating model, how do we make this at scale? How do you get a firm with hundreds of employees to change all the things and make it work? And of course, our mental models have to change, because we worked, technology was always deterministic. You said A plus B equal to C. So no matter how many times you said A plus B, the answer was C. In this AI world, every time you give a prompt, you'll probably get a different answer. And therefore, how do you deal with this non-deterministic world? But how do you make sure what you build has the robustness, reliability, and resilience of the deterministic world? That's what the challenge is for everybody. So this is a fundamental root and branch surgery of the way business is done, which is why this technology transition is so dramatically different from anything else that we have seen. Now, one clear learning we have is modernization of legacy systems cannot be deferred anymore. What happened over the last 60, 70 years is people would not replace the legacy systems, they just added to it. So if you go and look under the hood of a large enterprise, they will have mainframes from 1960, they'll have mini computers from 1980, they'll have LAN from 2000, they'll have all kinds of things, and all coexisting in silos. That is over. If you really want a firm to take advantage of AI, you have to fundamentally clean this up. So this is a massive, massive cleanup job which everybody is dealing with. There are reasons for that. One is the financial drain. Many large companies are spending 60 to 80% of their IT spend on maintaining systems. There's no business value out of that. They want to go from 60% or 70% maintenance and 30% new systems to 30% or 40% maintenance and 60, 70% new systems. They want to flip the way they spend money, but they can't do that with that fundamental cleanup they need. Moreover, many of these systems were designed in an era before you could have online attacks and so on. So security breaches, which you see every day, are just going up everywhere, and there are more state and non-state actors who are getting better at it using AI. So security is a huge problem for everyone. We have seen so many cases in the last few months. And because the data is all in silos, you can't even innovate fast. You don't have to be. So there are fundamental structural issues today we have. So demand side is absolutely demanding modernization. But the good news is, for the first time, because of AI, we have the tools now to do modernization fast and very quickly, and at a much more economic way. So we have a huge demand, and we have the ability now to do it.
Okay, that was Mr. Nandan Nilekani talking about how Indian IT services companies, Infosys in particular, are gearing up to take on the AI challenge. Speaking of the AI challenge, the AI summit, of course, is underway, and day 2 of the summit wrapped up yesterday. The spotlight was on big investments and bigger ambitions for India's AI future. Union Minister Ashwini Vaishnav said that nearly $200 billion in AI investments are already being planned here in India. Santosh Vishwanathan of Intel Corporation outlined a push to make AI compute pervasive, from hyperscale data centers to classrooms and small businesses. Filmmaker Shekhar Kapoor was also there at the event, and he's saying that AI could potentially add $1 trillion to the country's GDP. We also heard from former Niti Aayog CEO Amitabh Kant, who stressed that AI must be accessible, accountable and multilingual here in India to truly make a difference. Listen in to some of the big views from the summit, and thank you so much for watching.
है बहुत ही लोगों का उत्साह है, विशेषकर युवाओं का, नौजवानों का बहुत उत्साह है. इन्वेस्टर्स और इंफ्रा प्लेयर्स क्लोज टू $200 बिलियन का इन्वेस्टमेंट की प्लानिंग कर चुके हैं, जो कि आने वाले 1 से 2 वर्षों में मटेरियलाइज हो जाएगा. साथ ही साथ वीसी भी बहुत बड़ी मात्रा में भारत के स्टार्टअप्स में और विशेषकर जो एप्लीकेशंस क्रिएट कर रहे हैं उनके साथ जुड़ के भारत में इन्वेस्टमेंट, डीप टेक में इन्वेस्टमेंट लाने के लिए पूरी तरह से उत्साहित है.
I would like to start this conversation by seeking your views on Intel's AI strategy, semiconductor strategy for the Indian market.
Yeah, so I think we are very excited on the possibilities of what AI can be in India. And one of the key elements that I've mentioned is that AI, the same model that is applied on the West, will not work for a market like India. India needs a model that is scalable, that is frugal, that is everywhere. And I think Intel's strategy is to make that happen by building in key technologies that not just work great for data centers, but also works great at the edge, great in your hands, great in classrooms, great everywhere.
So, very recently, Tata signed up Intel as one of the first customers. Would you like to kind of shed some more light on that?
Yeah. So, I think our partnership with Tata is on two fronts, right? One is, how do we support the manufacturing, semiconductor manufacturing ambition that India has? That's one area that we are supporting with them. The second one is also, how do we start to build devices or electronic devices that are more meaningful for India, right? So the affordable AI PC was one of the key areas that we have begun that journey with. And we are very excited on what the possibilities are and what we can uncover together.
I think AI is absolutely incredible. I think it's the best thing that we can do. I think that this India will add $1 trillion a year to its GDP with AI. I think AI is the most democratic technology to hit us. And because we have such, we only talk about LLMs and large language models, but here's the problem. AI is a democratic technology. It goes right down the pyramid to those that really need it. And because with everything, knowledge, education, everything AI can do, what it can't do is be intuitive, right? And therefore, people who haven't had the opportunity to go and study in big institutions or even to study things. They have now AI to supplement all that and overcome, and they can be intuitive and innovative. And intuition and innovation cannot belong to AI, it belongs to human beings. And India is a society of innovation, innovative people, intuition. You can just see from this whole thing. 500,000 people are coming here, right? 500,000 young people. 1 year ago, nobody knew what AI was. Today, we have an AI meet and 500,000 young people coming here because what is AI? That's India. That's what it is. That's how it will change.
I really feel that AI should be driven to make it more accessible, more accountable, and to make it more multilingual, which is what India is doing. We should not end up with a digital divide, which the rest of the world is doing. We should make sure that the people of India benefit from that. And therefore, our focus should be in driving improvements in learning outcomes, in health outcomes, in nutritional standards, etc. That's the way forward. It is a transformational technology. We are living in the era of the greatest rise in productivity, and we should take full advantage of it.